Now, my main focus point concerns this question. Probably appropriate given the last question, and that is, what are junk bonds? Well, junk bonds are, put simply, high yield, high risk bonds. They are rated BB or lower, and they offer returns that are higher than investment grade bonds in order to compensate for that risk. And they're called junk because of the speculative nature of them. There is a higher risk that the issuer of these bonds is going to default. And that's why they're trading at lower prices and therefore higher yields. Now, junk bonds can come from anywhere, right? They can be corporations, they can be sovereign governments with weaker credit ratings. They could be companies that are financing leveraged buyouts. It doesn't matter the source that they come from. It's essentially just a designation of how investment worthy are they and what are the risk levels. Now, the default rate kind of tends to fluctuate. BB bonds historically have been around 18%. In terms of default rate. CCC rated bonds have exceeded 50% default rates at some times, and the recovery after default tends to vary in terms of how much you will get back for owning the bond relative to the risk of this. And so the trade-off here is what I've been hinting at. It's risk versus return here. If you're the type of investor that can stomach the risk here of potentially losing some, if not all, of your money, well then junk bonds may be appropriate for you. They are highly macro sensitive. During the past week or so, when US Treasury yields were rising, when recessionary risk was increasing, you saw a pretty big widening of credit spreads. And so that's going to affect junk bonds far more than investment grade bonds. Now, if you want to invest in these junk bonds, I would recommend ETFs, right? The biggest risk of holding junk bonds is their credit risk. That's why they have higher yields. And so in order to mitigate some of that concentration risk of an individual bond failing, you can get a high yield ETF or mutual fund that invests in a wide array of these bonds such that one failing doesn't lose some or all of your capital. Now, it's important to monitor volatility and historical performance and default history of the companies or the entities that have issued these bonds, as well as in those ETFs what the mixture of ratings are that is aiming to diversify away some of that risk. FINRA's Fund Analyzer, a great way to do that. Morningstar, a good way to do that as well. Just keep in mind, again, this is best for risk-tolerant investors. And for those who are willing to stomach that risk, junk bonds can help complement a well-diversified portfolio, but tread cautiously.